The natural extension of budget and standard is comparing the actual performance with budgets and standards. Such comparison helps the managers to take stock of current position and initiate corrective action if the actual started deviating from the standard. This comparison is called variance analysis. Cost has two components. One is related to quantity and the other one is related to price or a rate. For example, material cost is outcome of material quantity and rate. Overhead cost is outcome of overhead rate and overhead cost driver like a machine hour. If actual cost is different from standard cost, the difference could be either due to differences in the quantity or differences in the rate or possibly both. Variance analysis captures the overall difference and breaks up the difference related to quantity and difference related to rate or price. Quantity related difference is called usage or efficiency variance. Rate related difference is called rate or a price variance. Total variance is sum of the usage variance and rate variance. Before we discuss variance of different cost component, let us develop a general framework. In computing price variance, we assume the department is efficient in using the quantity as per the standards. In computing efficiency variance, we assume the firm or department is efficient on rate. This way, we can focus our analysis on the variance we are interested in. Our general framework for variance is shown on the screen. In this diagram, the extreme values are clear and easy to understand. On the right side, we have a standard cost. This is equal to standard price or rate times the standard quantity. On the left extreme, we have actual cost and this is equal to actual rate and actual quantity. The middle one, we have standard for actual. This requires some explanation. Price variance is a difference between actual and standard price times of actual quantity. Usage or efficiency variance is a difference between actual hours and standard hours times standard price. Let us see how this general framework is applied in different situations. The first variance is a material variance. The difference between actual material cost and standard material cost is a material cost variance. If you have a standard for actual, the difference between the actual and standard cost for actual is a material price or a rate variance. The difference between the standard cost and standard cost for actual is material usage or efficiency variance. Let us do an example. A health drink producer planned to produce 10,000 kg of a powdered ready to use health drink. Actual production for the month happened to be 8,000 kg of the product, 2,000 kg lower. One of the ingredient is a malt. The product requires 600 grams of a malt per kg. The cost per kg of a malt is estimated at 40 rupees. The factory actually consumed 5,000 kg of a malt, purchased at an average cost of 42 per kg. The standard quantity of malt for 8,000 kg of a finished product is only 4,800 kg. That is 8,000 kg of actual production times 600 grams of a standard quantity. The standard price per kg is a 40. This gives you a standard material cost of 1,92,000 rupees. The actual quantity consumed is 5,000 kg and the material procured at the price of 42 per kg. Therefore, the actual cost is 2,10,000. The difference between the actual cost, that is a 2,10,000, and standard material cost is 18,000, and this is adverse because we spent more. Now, we need to break this difference into price related variance and usage related variance. We need one more value to split this total variance into price and efficiency component. That is the middle value. That is, we need to find out what is the standard cost for actual quantity of a material consumed. We consume 50,000 kg of a malt and the standard price allowed is a 40. This gives us a value of rupees 2 lakh. Now we have three values. Actual cost of 2,10,000, this is on the one side. Standard cost for actual quantity value is a 2 lakhs, that is a middle value, and then the standard cost of 1,92,000, that is the last value. The difference between the first two value is 10,000 and this is material price variance. It can also be computed differently, that is differences in the price times actual quantity. The difference in the price is rupees 2. We paid 42 rupees per kg instead of standard price of 40, therefore 2 rupee difference. Our actual quantity consumed is 5,000 kg and this gives us a value of 10,000 rupees and that is adverse. The material usage variance is the difference between the middle and last values, that is the difference between the standard for actual material quantity and standard cost. The relevant values are 2 lakh rupee and 1,92,000. This difference is 8,000 and this is also adverse. we can compute the usage variance by taking into account the differences in the consumption times standard price. We consume 5000 kg of malt against a standard quantity of 4800 kg. The difference is 200 kg. At a standard price of 40 per kg, we get the same value of 8000 difference, and this is adverse. The total variance is sum of the price variance and usage variance or efficiency variance. That is 10,000 rupees adverse plus 8,000 rupees adverse, and the total variance is 18,000 adverse. In the above example, we have an implicit assumption, that is material consumed is equal to material purchase. However, in many cases, material purchase is slightly more than material consumed. Suppose the purchase department procured 5500 kg of malt at 42 rupees per kg. The actual material purchase value is 2,31,000. We can now compute one more variance called material price variance or material purchase price variance. It is equal to the difference between the rates, that is 2 rupee per kg, times the total purchase quantity of 5500 kg. This is equal to 11,000 rupees, and again adverse. In evaluating the purchase department performance, management can use this value.